How a patent valuation could change your business. Greetings, this is John Cronin from the Invent Anything podcast series. In this episode, we'll cover patent valuations, which are a vital process that assesses the IP value and influences business directions. It impacts areas like quantification and fund generation, market exploration, and things like partnership discovery. Valuations expose opportunities for enhancement, like portfolio expansion and strategic considerations. And many times, you can leverage your patent valuation in business to gain clarity on your IP value, align your stakeholders, and have prompt strategic shifts if needed, ultimately transforming your approach to resource allocation.
Inventions keep the world spinning. From fire in the wheel to today's high-tech, inventions power change. Turn your inventions into reality. Learn how to get your ideas to market. This is Invent Anything with John Cronin.
We'll cover 6 topics in this podcast. Topic number 1 would be, what is a patent valuation and what's involved in doing one? A second area would be the proforma patent valuation challenging your business, because patent valuations ultimately challenge your business. And topic number 3, we'll talk about 10 areas where patent valuation can really change your business. In topic number 4, we'll talk about would I actually write patents more valuably if I knew about patent valuation. And then in topic number 5, we'll talk about how you enhance and change your patent valuation. Because once you've done one, you'll know what influences patent valuation, and then we'll know how to change patent valuation in the future. And finally, in topic number 6, we use patent valuations to actually change your business, which gets to be really exciting. So I chose these 6 areas for a number of different reasons to take us through patent valuation. Once we do that, we'll then wrap up. There is one caveat here. This podcast is generally for smaller businesses, mid-sized businesses, less than $1 billion, say, maybe a couple billion. Very large companies would not use patent valuations the way I'm talking about here today. For the audience, we've considered a lot of different audiences at different podcasts. For this podcast, we think the audience might be for those that are not yet familiar with patent valuations. So this primer is for you. Another audience might be for those small companies who might be considering doing a patent valuation. This is a perfect podcast for that, because it'll show you the ins and the outs. A third audience might be for those companies that already have patents, where you might be considering a patent valuation, considering that maybe it can help change your business. This is definitely for you. A fourth audience could be the companies that may be developing patents right now. If you want to do patent valuations, we were talking about, you might actually write your patents different. And for a fifth audience here, we think that companies that already have patent valuations, you might consider the ramifications of patent valuations versus just getting the number. So this podcast deals with all sorts of different things you can do with patent valuations. And finally, a sixth area for audiences, maybe if you try to understand IP strategy, of course, you don't want to understand how patents are valued to inform your IP strategy. So this is John Cronin from Invent Anything, and coming up, we'll explore patent valuations, where data and expertise meet. We'll uncover 6 ways to leverage intellectual property with a focus on licensing. We'll see how these valuations can use data and comparables to assess the value and potential suitors. Like income statements, the patent valuation is a pro forma valuation that will allow you to make many decisions. We'll learn things like how you can use this valuation to generate new revenue insights, maybe even potentially reshaping the company. And we'll also learn how these valuations can demand proactive management changes in the company. So let's get right into it. Let's discuss what is a patent valuation and what's involved in doing one. It turns out in an earlier podcast, we talked about the different ways you can make money with patents. And there's basically 6 ways. One would be infringement, one would be licensing, one would be shareholder value, etc. I won't go through those 6 here because we can go look at that other podcast. But what we're doing here is to use the most rational way of valuing patents, which is licensing. So in licensing, what you do is you figure out what the licensee's revenues are and take a percentage of those revenues as a royalty. That's about as simple as it gets. So we can actually create a patent valuation that assumes that you're going to be doing a licensing model. Valuations have many uses, to look at third parties' data. So for instance, all the information in a patent valuation comes from somewhere else. Market data comes from market studies and revenue royalty rates come from databases of other deals. So all of the data in a patent valuation comes from third parties. One of the areas that is unique to the patent valuations that we do is we actually risk adjust the patents themselves because we don't believe all patents are created equal. One of the things about valuations as well is they usually include a comparable. So even though there's a licensing model that one could look at to figure out the value of the patents, we also look at comparable transactions over time so that we can sort of triangulate between the valuation, which is pro forma, comparables, which are found in the market of deals that we've done, and a third area, which is just to understand the average value of patents in, when patents are sold. So one of the things is that patent valuations produce real numbers, meaning dollars. So the output of a patent valuation is not subjective, it's a hard set of dollar numbers. And this allows you not only to determine the value of your patents, but also value to who. You see, in patent valuations, in a licensing model, you're not only trying to figure out the markets, but you're trying to figure out the companies in those markets that might want to take a license. So many times, patent valuations will not only tell you what the value of the patents are, but they'll also tell you who they're valuable to, which is really vitally important. And patent valuations are really just like income statements. And so if you're a business person with income statements and balance sheets, you know what I mean. But if you don't know what an income statement is, it's really revenues over time, and then subtracted from the revenues is the cost of sales, the SG&A, et cetera, where you can get below the line of a net income profit or loss. So these valuation models look like an income statement, if you will. One of the things about patent valuations is that it's really important to have some expertise to do this. Even though it's a pro forma-like model, there's a lot of expertise in trying to figure out the right markets, the apportionment of the market, how to risk adjust the patent, et cetera. Generally, accountants don't do patent valuations because they just don't understand patents. So you really need kind of a cross between someone who understands economics and accounting principles, et cetera, but also a deep understanding of patents. So it goes without saying we need a sort of strong expertise to do patent valuation. One of the things that happens as a result of a patent valuation is the results have many uses to the business. And we're going to talk about that in numerous ways in other sections below as we start to get into it. But one of the things about patent valuation is that the expertise in doing it and the reasons for doing it come together, because the patent valuation really becomes more like a strategy, if you will, because you're trying to figure out in what market should you license. Sometimes when you can license in one market and sell products in another. So there's a lot that goes into the patent valuation thinking. Let's jump into topic number 2. Pro forma patent valuation challenges the business. So by this we mean that once a patent valuation is done, it does things to change the way people in the business think. So first one is, if your business already has revenue and you do a patent valuation, it could provide new revenues. So that's kind of interesting, right? These are revenues that go beyond what you're already doing. That's a very important reason to do patent valuation. One of the things is that patent valuations may end up actually doing patent licensing or patent sales. Now that may be good or bad. What we mean by how could it be bad? Well, you could end up taking your patent valuation, which would assume that you license in certain markets, and you license in certain markets, which means that you might create competitors to you by licensing it. So the question is it an exclusive license or is it a non-exclusive license? Are you licensing to make money, or are you licensing to, do more than make money, some sort of strategic partnership? So there's a lot of things that can happen, good and bad, from following the results of a patent valuation. So we have to be strategic about that. One of the things about patent valuations is they may not end up being believable. This happens quite a bit. So suppose your business is doing $20, $30 million a year in revenue, but the patent valuation is $100 million. The question would be, how the heck could that be? Well, the answer is really that in a patent valuation, it's a licensing model that would assume some licensing expertise going into various markets with various efforts to close deals in licensing. So it's just like a revenue projection for a business, where the patent valuation is a revenue projection for licensing. So that's why patent valuations can actually be larger than the revenue of the business today. This happens a lot with startups. Startups, for instance, have maybe $1 million or $2 million of revenue, and the patent valuations could be 30, 40, 50, even 100 million. So yes, many times patent valuations may not be believable unless you put it in the context of why they're done. And once you get a valuation where it is much larger than the business, this is pretty exciting because now investors and CEOs can start asking the question, how do we get to that opportunity? One of the things that can happen in a patent valuation is the number ends up too low, below your expectation. So you're doing 10 or 15 million in business. Let's just say the patent valuation comes in to be 1.4 million or 2 million or something, which is far less than the expectation. Well, what that does is it sets up a whole bunch of discussions, things like why did we even get these patents, etc. It turns out that all patents are not created equal, so the patent's value may be related to defects in the patent, not defects in the idea that you're trying to get the patent on. There's many reasons why patent valuations can be low. So it's important to know when you're trying to do a patent valuation that it could come in, what you're thinking, it could come in much higher, it could come in much lower. And because of that, you need to carefully think through that about whether or not you should do a patent valuation. And it's always great to have an expert who can kind of give you a back of the envelope calculation before you even start with this patent valuation. One of the things about patent valuations is they end up identifying markets that relate to the business, or they could identify markets that are not in the business today. And that's kind of interesting to find new markets for the patents, which probably relate to the products that you're building. So patent valuations is a great exercise to find new markets. And this happens a lot to us. We're valuing 2 or 3 markets and we find out there's 2 or 3 other markets where the patents may even have more value that was unbeknownst to the CEO or to the company. One of the things about patent valuations is it's for a limited amount of time. We do a 5-year window. I mean, certainly patents last 20 years, your patents have 15 years left, but on a conservative basis, it's only able to forecast within a 5-year window. The other thing about patent valuations, which have a limited time window, is that when you do a patent valuation, it's relevant only for that window. But you can't later on, maybe 5 years from now, rely on the patent valuation that was done earlier because markets change and trends change, compound annual growth rates changes, deals changes. Sometimes patent valuations may cause fractions in the business. What I mean by this is sometimes, let's just say you have a patent valuation that's pretty substantial. Well, maybe the board would suggest that you become a licensing company versus a product company. And the CEO doesn't want to become a licensing company, he wants to become a product company. And so sometimes you have all these kind of things that could fraction the business through getting a patent valuation. Suppose you try to raise money and the patent valuation is too low. Well, all of a sudden that may mean maybe we don't raise the kind of money that we thought we did, or maybe we shouldn't raise money. So there's a lot of things that will happen once you truly assess the value. Let's sort of think about it in your own home. Let's just decide that you're going to sell your house and you have some sort of thought about what your house is worth, and you bring in a professional to kind of give you an idea of what the value is, because maybe who's ever going to buy is going to take a loan out based upon that value. And then you find out that the house is worth far less than you had thought, maybe because of the neighborhood or other things that have happened. Sometimes you might find that your house is worth a far lot, and that might change what you think. This happened to me personally. I had a home in Florida, a second home, and found out that the home was worth a lot more than we thought. So we ended up selling it. So you can see how patent valuations and the numbers really can affect infraction business. One of the things about patent valuations could be that it becomes a matter of record, meaning that if you ever decide you want to litigate with these patents and you have a patent valuation on record and that gets subpoenaed, that might actually set a bar for the value of your patent. So if you want to sue somebody for, say, $30 million, but you had a patent valuation of $5 million, if that was subpoenaed, there'd be a general question: why do you think you should be able to get $30 million in a litigation when it was valued earlier at $5 million? So you kind of have to think through the repercussions of having a patent valuation on record. There are many issues here. Can't go through it in this podcast, but again, expertise will help sort that out. So before you do a patent valuation, these are some of the things you want to think about. One thing is that patent valuations could be, very material and therefore problematic for management if not taken. Meaning, suppose the valuation is 80 million and you're doing 5 million in business. Well, the question would be, why aren't you trying to get money for your patents in those markets? Why are you not taking action? So sometimes patent valuations by themselves can be problematic for management, because if the number is much larger and you're not taking action, and you're not going to take action, then that sets up a real problem for management and investors and boards. So a lot of times we have to advise when we're doing these patent valuations to be kind of reasonable and practical about where the markets that we're valuing, the size of those markets, et cetera, so we can end up doing a patent valuation that's rational. You may be thinking right now, hey, wait a minute, John. You're telling me this patent valuation number could change based upon all these factors. So what the heck is a patent valuation anyway? Well, one of the things about a patent valuation is it's unlike the Kelley Blue Book, where you can look up the value of your used car. Patent valuations are based upon which entities would value those patents and how they would use those patents. So it does turn out that patent valuations are really a strategic tool to understand where the business should go. Finally, patent valuations can turn your company into an IP company. And this has happened to us a number of times, meaning that the IP value is so high that sometimes investors says, you know what, we've been trying for 3 or 4 years, trying to produce products and sell them at these levels. It might be better that we just become more of an IP company and start to really aggressively license this stuff. So that could be a change. Well, coming up, you'll see how we can unlock the potential of patent valuations for your business. Patent valuations is more than an afterthought. It's a strategic tool that you can use to reshape your company's path. With a quantified set of assets, it paves the way for new revenue streams through licensing or sales. It resolves a lot of business issues because now you understand the value of the patents. Ultimately, you'll see how patent valuation aligns with your IP strategy as well. And from that, you can then move it to where you can optimize your company for success using patent valuations to help drive further fundraising efforts or to serve as an asset as part of your core business to value in all sorts of other negotiations. So stay tuned, coming up. So topic number 3, we're going to get into 10 areas how a patent valuation could change your business. Now, note that there are many more than 10, but we'll just hit some of the ones that we see a lot. If you ever want to do a patent valuation or think about it, using this podcast and some other podcasts we have on valuation, you might consider how patent valuations would change your business. And that might be one of the reasons to do a patent valuation. Well, the first things to note is, you have your patent assets and now you've quantified it in terms of a value. So that right there could tell you that can change your business because you actually know how much is in your bank account, if you will. So that's an important thing to know. To not know it means that you don't know what the asset value of your company is, would not be a good thing. Does that mean that every company that has patents should get a patent valuation? Well, I would think that a lot more would or should than do. A lot of companies don't even know you can value a patent, and that's one reason why they don't. A second way that we can see your business change is that sometimes the IP can be sold or licensed once you do a patent valuation, using the valuation as one of the negotiation points. If that's true, then all of a sudden you have some new funds in the company. So that's great news, right? That here's some dollars associated with an asset that you weren't leveraging. A third way is that sometimes patent valuations determine new markets so that you can develop new product derivatives into new markets. This happens quite a bit. When a patent valuation is done on, say, supposing you have silver particles in the handle of an endoscope and you're selling those as a portion of the endoscope because it's good for making germ-free endoscopes. And then you find that one of the values could be that it's eliminating one of the washes after every operation. I believe endoscopes get washed 2 or 3 times after every operation. And what you could do is start marketing your silver particles in the endoscope handle as a way of reducing the amount of times of doing washing. So now you can start developing technology to actually see really how many washes you need and what kind of wash do you need, etc. So that becomes a new market, which was learned from the patent valuation. Sometimes patent valuations can help you create new IP as well. In one example recently, we did a valuation and found 3 markets that the patents were directly related to. But in further understanding the patent claims, we understood that there were 12 other markets associated with this. And so our client got pretty excited, recognizing they could take the base patents and add to it other patents to move it to other markets. So the valuation changed dramatically, going from 3 markets to 12 markets. Another thing that could impact the business is that sometimes patent valuations resolve other business issues. For instance, if your IP is not that valuable and you put a lot of focus on having IP that could protect your business, and if your IP is not that good, that's not going to protect the business very well. So you might start thinking about other ways to protect your business by either getting better trade secrets in place or getting other patents in place, etc. So many times patent valuations resolve other business issues. And a 6th way of thinking about this, sometimes patent valuations show us new partners, new customers, and even new competitors. You see, when you do a patent valuation, you're actually looking at potential licensees. When you're looking at potential licensees, if you didn't know who they were, and now you figured out who they are, you may say, those potential licensees actually could acquire us. So you can see how patent valuations could actually show you new business models and new partners. Another area is that patent valuation forces a decision by the company. We mentioned what happens if it's too high or too low. We mentioned what happens if you find new markets. We talked about things like expanding a portfolio, but ultimately a patent valuation is a real number that then you can look at to make some decisions. So ultimately, patent valuations will drive some decisions, hopefully in a good direction. Sometimes patent valuations lead to the idea of if the IP is so valuable, the business is worth, say, 5 million, the patent valuation is 30 to 40 million. A lot of companies we work with decide to take their patents and put them in a holding company. Now, I don't have a podcast on this, but the idea of a holding company, and maybe I should, but the idea of an IP holding company is essentially take the patents and put them in a separate entity, and that entity then licensed to your company. So the holding company is generating revenue from a license of the patents in the holding company to your company. And that's done for many reasons to be strategic. It's also done, particularly if you're going to sell the company and the patents have many more markets in them, and you're only trying to sell the company relative to the one market, it makes a lot of sense to use a holding company. Sometimes patent valuation forces other IP efforts, like evidence of use, a freedom to operate, or an IP story, meaning suppose the patent valuations appear to be very good, and you find some potential licensees, you might say, I wonder if there's evidence of use that they're actually violating my patents. So you can see how patent valuation could kick off other IP activities, and many times they do. And finally, in the 10th way, sometimes patent valuations sort of energize a company to raise new funds. This happens a lot. So we're called in to do a patent valuation because people are considering whether they want to start licensing their patents, and then they find out some new entities and new markets and new potential partners, and they start to think that, maybe we should start developing products in those markets. And so now they have a sort of use of funds, so they might raise money, or they might raise money to actually hire licensing executives, etc. So a lot of times patent valuations will be the basis of some new ideas to raise some new financing. Now that's pretty cool, 10 ideas of how patent valuations can move your business. Let's move to topic number 4. Ask the question, did you actually write your patents so they would be valuable? Think about that for a minute. Did you actually write your patents so you'd hope they'd be valuable? I would tend that this is not the case. I would tend that 99% of the companies that we work with develop the patents sort of as an afterthought to some product innovation. Well, they develop patents because they know they're probably going to be good for the business somehow. But there's never sort of the thinking of let's develop patents to get a good patent valuation. Once you do a patent valuation, it's almost impossible to develop patents without thinking about why shouldn't we develop patents to have a better valuation. So you really write the patents so you get a better valuation. Most patent developers write patents for very limited uses, meaning they're thinking about infringement. So they're trying to write patents that they can use to sue others if needed. I come from the belief that if litigation is what you're writing patents for, it's the wrong use because litigation is so tough and so expensive and so long. But a lot of patent developers might start thinking about writing patents for other uses, particularly for licensing or for some strategic reason. Patent valuations, when we do them, show the defects in the strength of patents. So we mentioned the things that go into patent valuation, the market size, compounded annual growth rates, trends like that, cost of capital, licensing revenue from comparables, etc. But you can use that to determine the markets and the value of the patents they're in. However, one thing that's really important is to assess the strength of the patent. Is the patent easy to invent around? Is the patent reverse engineerable, easy to detect? There's lots of questions we can ask. And by doing this, many times we're going to find patents that have a lot of defects. So when we do a patent valuation, we replay back to the company where the defects are. Now, this is good and bad because you can use this to essentially help improve the next versions of the patents. One thing is that the patent valuations show that the markets could have been covered but weren't. So maybe there are customer relationships or supplier relationships that the valuation covered that you found out through the patent valuation. So that may give you some new opportunities. One thing about patent valuations is they show the patent portfolio was developed, but then at some point it just stopped. And all of a sudden you've lost this continuum of filing patents. And even though innovation continues, the patent stops. And this is one of the things that impacts the value of patents quite a bit. If there's no sort of continuity of what happens with the patents in the market as the markets evolve. And so it's always important to think about when you're starting a patent portfolio, to think about how over a long period of time, your technology is going to change. So for patent valuation, it's always much better to have patents that go over a reasonable set of time. We've done a lot of deals where all of a sudden, and we did one recently, we stopped the patent valuation because we found out that the patents that we were valuing had all expired except for one that was going to be expiring sometime next year. And so we called the client and said, after we did this study, we recognized that these patents can't be licensed or sold. And that was unfortunate. We just stopped the patent valuation. One of the things that we find in patent valuations is they show the lack of or the support of the IP strategy. So sometimes we see patents, but we see no trade secrets. So patent valuation is what we're talking about, of course, but for patent valuation is also based upon a backup of trade secrets that makes the patents more valuable. So we'll consider that in patent valuation. One of the things about patent valuations is they show the disconnect between the company's products and the patents. In one company, the investors had boasted to us that they had over 300 patents covering their company. And because of that, the investors had put in quite a bit of money into the company a number of years ago, but they decided they want to get a patent valuation. We can certainly value the patents in the markets that they're in, but this is a true story. All 300 of the patents had nothing to do with the products that were being developed. Imagine learning that as an investor. So certain patent valuations can show a lot of things, but one thing it certainly does is show how well the patents cover the products that you're producing. And then we talk about timing issues. The patents can become stale because technology can keep changing. So it's always important to think that way about how to update the patent portfolio to improve the valuation. And then finally, many patent valuations show that the patents didn't have any business thinking, meaning that they got patents on certain parts of the business, which is less valuable than other parts of the business. So maybe the way the customer uses your product is where the patent should have been, but you patented the widget, which is a small portion of the final product. Well, coming up, let's see how we can revamp the patent valuation to use it to improve the business. You'll see how we can enhance your portfolio by prioritizing value-driven strategies, how we can allocate resources more wisely, how we can gain immediate insights into IP value, and then take actionable steps to unlock that value. And then finally, how we can use patent valuations to reshape the strategy of the company, maybe support the CFO's thinking of value, and ultimately turning your company more towards an IP-focused enterprise. Let's move to topic number 5, enhancing and changing a patent valuation. If you did a patent valuation before you got a patent, but that would be used for benefit, like pretend or assume that you're going to get a patent, even get some claims written and just assume that they're going to be issued and do the patent valuation based on that. What's interesting about that approach is that by doing that, you'll understand what the value of the patent will be before you write it up, which would make great sense, right? The other thing it will do is because it's a pro forma valuation, you can literally adjust the patent claims or adjust the invention and then run it back through the model to see if the valuation goes up or down. This is such a wonderful, clever way of developing intellectual property and invention. So doing a patent valuation before you actually get the patent might sound crazy, but we do it a lot. One of the things about trying to figure out that value would be added by expanding the patent portfolio with more filings and less continuations. This happens a lot where a company might have 8 or 9 or 10 patents, but they're really just continuations of the same invention. It's much better from a valuation standpoint to have 8 or 9 separate inventions that don't relate on each other. And one could say, well, wait a minute, my patent attorney is saying that we should do a continuation strategy. We totally agree with that. But if you want to talk about patent valuation, it's far better to have 8 or 9 separate family member patents than everything in one family. So it's something to consider. And we can talk a lot about that in some future podcasts. One thing is that value could be added by expanding the patent portfolio by essentially looking at your portfolio and inventing around or invent on top of your own patents. We actually have a podcast on inventing around or on top of patents that you might want to take a look at. But why are we talking about that? Well, you remember or recall that I said that one of the things that we do in our valuation is we assess the risks of the patent. Is it easy to invent around or a top of? Is it easy to reverse engineer, etc.? Well, if we know that that's a risk factor associated with a patent valuation, why wouldn't we think of our patent portfolio when we're writing it to address those issues that are risks? So literally, you're creating a patent portfolio, knowing about how to do patent valuation, make the patent valuation better by doing these extra types of inventions. One other way to improve the value here would be expand the patent portfolio in the value chain. And what we mean by that is wherever your patent sits, you always have a customer and a supplier. And sometimes getting patents by the way your customer uses your product or service, or sometimes getting patents on the way your supplier might supply innovation to you, can create more value and actually a stronger portfolio. One of the ways to change value would be to expand the portfolio by reducing the IP risk factors. We mentioned the event around, but there's other risk factors like easy to detect or is it market ready, etc. So what we would recommend always in a valuation is we would come out of the patent valuation, but would also come out with things that you can do to improve the value by minimizing the risks of the patents. One thing to improve the value here would be to expand your patent portfolio in the apportionment area. And by that, I mean, suppose that I talked about that endoscope handle with the silver particles, and I'm trying to value that, and it's, say the endoscopes cost $1,000, the handle cost $100, so my invention is 10% of that $100 handle. And so, when I'm valuing it, that's the size of its market. But on the other hand, I could say that my patents read on, the handle with the plastic, but maybe I can start saying that the rest of the endoscope might have these nanoparticle, silver particles in it. And so now I've expanded my patents in an area for a larger market share of the endoscopes. One of the things is that, we would try to add and expand a portfolio with sort of longer term timing involved, meaning that even though we use a 5-year window for valuation, it's always great to have some patents that may be, issuing in the 5th year so that you now got even more time for patent valuation. So sometimes we'll do a patent valuation for a set number of years, but we can then start talking to investors about how extra value could be added that goes beyond the time limit that we're talking about. So it's the idea of timing with the patent portfolio is really important for valuation. One thing which happens quite a bit with patent valuations is that some patents, when you read them, you can easily see what they're doing and be able to create the patent yourself. And this is, the patent office has this based upon sound theory of operation concept, where patents have to be written that way. But if you can have patents that are so designed where some of the patents, maybe some of the method steps are trade secret, you have a double strength because the patent will protect someone from using or selling your patent, but there may be some critical steps that are held as trade secrets. So you not only can you protect if someone tries to copy you, but you're double protecting it because they can't even figure out really as easily how to copy you. So that's one way to produce more value. And sometimes when we do patent valuations, we talk about this limitation. And finally, patent valuation can be expanded by adding more patents to more markets, as we talked about before. Simply recognizing that you can expand any kind of portfolio with the same concept in other markets will raise valuation. Now, in the last topic number 6, we're going to talk about using the patent valuation to actually change your business. And this is based upon some simple things that we've seen over the many years we've done it. But we've been doing patent valuations for 25 years, maybe a couple, 2 or 3 a month. So we've seen a lot of changes of businesses over time as we start to do these patent valuations. So first of all, how can we sort of talk about, some of the changes to your business from the things that we've seen? Well, one change to the business is the patent valuations will immediately put optics on your IP, meaning that it's no longer a guessing game about what your patent value is. You're going to get a hard number. So that's an interesting thought for any business to now understand what their asset base is. Another thing that patent valuation can do is it can produce actions to get value from the patents. And when you have patents, you're kind of using them in an invisible way, that basically you have patents and people can see them, and there's a sort of invisible threat that if someone copies you and infringes your patent, you can go after them. But what happens here is when you do patent valuations, not only does it make visible what the value is, but also creates a mandate of actions you need to take in order to get the value out. One of the things about patent valuations, it directly shows the value of the importance of the patents to your business. And sometimes it shows that the patents aren't that valuable. We've had companies that we've done valuations where it's not that valuable. And when the CFO and the CEO get together and say that they're not going to continue to pay maintenance fees so they can save money. And so that's sort of the negative side of a patent valuation, but certainly the positive side is there as well. Another thing about patent valuation is it allows us to sell our products or services, to our customers. But now we will know the value of our patents. So if you had recognized that your patents are highly valuable, you might decide to start thinking about how to change the product prices or the service prices of your product offering. Because if the value is very large to different markets or within one market, it'd be rational to recognize you've got a lot more value there. So you should have a lot of discussions about how you can raise the value of your product or services because your patent valuations are so high. And this happens quite a bit. The average sort of gross margins increase by having patents is about 35%. So a lot of companies, when we do valuations, don't recognize that because they have patents, they should be charging more for their products. And you can do that, which means because others can't copy you, you should have more of an ownership of the entire market. One thing that happens is that patent valuations will get management and investors aligned about the value of the patents. We talked about there's no more question that here's a dollar value of it, but now you've got that value, you can now properly debate it between, say, the management and the board as to what to do with that value. And that's a game changer for a business, is to have that discussion. Another thing of patent valuations is that there'll be an immediate change to your patent strategy. Imagine the value of your patents being high, and also imagine that tells the CFO and the CEO that the patents have a lot more value than they thought. It's very likely to then force the hand of getting more patents in certain areas. And again, if the patents are not as valuable, it may force the hand to improve the patent strategy to get more valuable patents, or not to keep proceeding with filing more patents because the area is not valuable enough to have patents in. We talked about the CFO. CFOs are our friends. Once we do the valuation, they love it because now they have a hard number on their books. What they're going to do with that is they could apply it to their balance sheet as well as their income statement. I would recommend not to do that right away, to be more thoughtful, because as soon as you start putting numbers on an asset base, investors and owners of the company will start asking the question, how do I get that asset out? So it's good to do a patent valuation, understand its value, but when you want to move it over into the balance sheet is a whole nother discussion. Patent valuations will likely move the company to add more resources to do activity around patent licensing, for instance, or getting the value out. And patent valuations will likely reset the thinking of management to, now that you have this number, maybe we have a different business. And finally, we mentioned this before, but patent valuations for some companies, they end up being so high, and the business is so tough to do by developing products and services on time, at cost, etc., that many times it might be valuable to just sell the patents or license the patents. There's a story of Dr. John who invented the toothbrush, the rotary toothbrush. He saw how a professional toothbrush, had rotors in the doctor's office, dentist's office. So he decided, why not make a handheld one for the user? And he did that, and over a number of years, that's a story we understand, that he was able to generate a business of $10 or $15 million, but wasn't able to get it beyond that. He owned a lot of patents on it as well. So basically ended up selling his business to Procter & Gamble, using the patents as one of the value aspects. And within about a year, Procter & Gamble, as we understand, created $1 billion category for the rotary toothbrush, because Procter & Gamble had the brand. And so you might be a company that has great intellectual property, but because of brand issues, you're not able to extrapolate to get the value. So wouldn't you rather get 3% royalty rates from Procter & Gamble's $1 billion market, if they could push it to that market, versus you continually trying to figure out how to sell your business for 10 or 15 million a year. So we'll end kind of there with all these areas that can help improve your business. And let's sort of wrap up. In topic number 1, we talked about what is a patent valuation and what's involved in doing one. We discussed a lot of issues here. We discussed how when you focus on IP for valuation, it's really a licensing model. There are 6 ways to make money. Licensing is the way we do patent valuation. We talked about that the patent valuation has third-party data, hard data, that comes from third parties that are used in the proforma model. So therefore, patent valuations are real and irrelevant. The assessments really come from understanding the impact of your patents to markets. And we talked about how you can be in multiple markets with one patent. We also talked about how, similar to income statements, patent valuations are pro forma models of how money is made over time in licensing. And these serve for all sorts of purposes. And remember, we actually touched on this, but I'll say it again to wrap up that topic, is it's really important to have expertise to do patent valuation. It's not something that, accountants can do or even business valuers do, because patents are a very unique entity, a very unique asset to value. In topic number 2, we talked about how this pro forma patent valuation can really change your business. We discussed various things like how it proposes challenges for the business, because once you understand you have some new revenue potentials, it's an immediate question to ask, what do we do about that? Sometimes these valuations may uncover other markets. Sometimes these valuations may show you time-sensitive issues of getting the value out of your patents. Sometimes it may trigger your thinking to actually do a litigation. Sometimes it may trigger that you can start thinking about your company more as an IP company. So we can see how pro forma patent valuations really can challenge the business. We talked about in topic number 3, 10 various areas as examples of how patent valuation can change your business. We talked about once you quantify your patents, it becomes an asset. We talked about how it can leverage your company by maybe improving licensing as a new set of funds. We talked about how it gives you an idea towards fresh new markets. We talked about that it can resolve other issues like understanding true value IP may actually change the plan of the company. We talked about how it can reveal new partners or new suppliers, new competitors, new potential licensees. We talked about how it can lead to other IP-related initiatives, like if you find potential licensees that should have good licenses, even when they don't, maybe you would explore evidence of use as an IP focused activity to see if they're violating your patents. This might be the way that you could have an action to change your business to raise money based on a new patent valuation. So there's a lot of different ways that patent valuations can change your business. In topic number 4, we talked about, do you actually write patents so they would be valuable? We actually created the paradigm that why don't you pretend you're going to get the patent, write the claim, and then value it, and then see if the patent you were going to write is valuable enough to write. We also talked about using patent valuation this way as a great strategic exercise. We talked about that these valuations can literally pinpoint weaknesses and strengths in the patent. We talked about how you can actually understand the portfolio in its context. Like we talked about, having a lot of continuations versus 10 different filings. You have 10 continuations, and you might decide that your patent strategy is better to have separate patents from a valuation standpoint than 10 patents in one continuation, one family. We also talked about how many times when we look at the patents that you're writing, but when you do evaluation, you recognize the flaw in your strategy, that the patents may be written too much towards what you're doing and not enough towards what the customer is doing, etc. And then we talked about all sorts of other issues like timing and thinking about having a portfolio over time that may be more valuable than sort of bunching up patents early on. In topic number 5, we talked about how to enhance and change your patent valuation once you understand the patent valuation method. We discussed enhancing your patent valuation by reevaluating your filing strategy. We talked about changing your patent valuation by sort of shifting to maybe inventing around your own patents or on top of, or targeting your value chain, or ways to rewrite your patent portfolio to reduce the IP risk factors we talked about. We also talked about how when you understand the patent valuation and top licensees in the valuation, that might reposition your company into some new markets, but it certainly will reposition the filing of new types of patents, new types of markets. And finally, topic number 6, we talked about using patent valuation to actually change your business. So now we've gone all through this, right, in terms of understanding what it is and the impact to the business and how it might change things, and gave you some examples of that. And then we talked about writing patents as if you already had it, doing evaluation as if you already had the patent, and then using that to affect patent strategy. In topic number 6, we kind of completed this by saying, how do we use these patents to actually change our business now? And we'll give a lot of examples of that. See, the valuation, once you have a real number, can spur all sorts of new activities. It underscores the importance of patents. It tells you how you can, look at the patent value and understand the relevance of it. It talks about how you might be able to use patent valuation to improve your service or your sales. We talked about how the patent valuation can help you actually shift in strategy, and how a CFO might start to think about this differently, how he can include the value of patents, maybe even in the balance sheet. We talked about that these patent valuations prompt a broader direction of thinking for your IP strategy. And finally, we talked about that in some cases, patent valuations, and we've seen this more percentage of the time than you would think, with a company actually decides because of the patent valuation that they want to become an IP company, which leads to all sorts of questions like IP holding companies and all the rest. So I hope you enjoyed, us taking a look at patent valuations and how it can impact the business and why you might want to have one done, and talked about all the risks and all the benefits of doing one. If you like this, please subscribe and come join our Invent Anything podcast on Inventors at Work. This is John Cronin from Invent Anything.